Hi everybody, this is Thomas Wynn, CEO of Wynn Capital with the 2022 first quarter market summary. If you have any questions or comments, use the information below to connect. As everyone knows, the market has declined this year. Inflation, the pandemic, supply channel issues, and the Ukraine war has turned investors negative. Before we go into the details, let's take a look back in time and then we'll zoom into the present to get some context about where we are. The graph on the screen right now goes all the way back to 07, 08, and 09, the bottom of the real estate recession. If we draw a line from that bottom to the market top at the beginning of this year, that's probably right around there. We have a 600% in about 13 years, a 600% equity rally. Not that many people are 100% in equities, but the equities that you own in your portfolio have gone up about that much. Now this is the S&P 500, and not everybody owns all S&P, but that's a good idea of where we've been in the past. If we zoom in and go closer to the current year, this is the dividing line of the year. 2021 is on the left. The first quarter is the difference between the little dotted line, and this is the end of the quarter. So we've got the second quarter. And it's easy to see that we've been very volatile with about a 14% decline, highlighted by the 1,000.4% Dow drop. In January, we had a rally back up. The Ukraine war was looking like it was going to get going. The day that they invaded was a Wednesday night, and on Thursday morning, the market opened way down, but never stayed down. Rallied, let's see, it rallied 4% that day from the lows. So a lot of people obviously got out afraid of lots of different outcomes. A week or so later, the market was up 7.5%. Of course, we've declined again, then rallied again. The last rally went from almost an 11% rally. And here we are in the second quarter, where the market has been very weak again for all the reasons I mentioned above. Now let's take a look at how the quarter went. This first slide always tells us how each of these different types of assets performed during the quarter. And at the bottom, for context, it tells us the average return, the best and worst quarter, and when that was. What is unusual about the decline, which was about 5% for US stocks, and around the same for almost every other category of stock or equity, the bonds were down. Lots of reasons for bonds being down. The biggest one is inflation and the Fed raising rates. When interest rates rise, bond prices go down. And it turns out this was the worst performance ever. 2022 first quarter set records for both US and global bonds. It was a double whammy on our portfolios. A 60-40 portfolio would have suffered 5% declines in the quarter in its equities, and then also another almost 6% decline in its bonds. They don't always move in opposite directions, but they usually move in opposite directions. But like often happens, or not often happens, sometimes happens, bonds and stocks go in the same direction, which really hurts portfolio returns. This stretches out the time period we're looking. And if you go past one quarter into previous quarters, you're going to collect a lot of the high returns of the previous 12 months. So even though we've had the decline, the last 12 months are still up very strong. International emerging markets, which are the riskiest and most volatile, they've been very hard hit. And bonds, even for the last 12 months, are down. Real estate is the big winner for that time period. If you go into annualized returns, any return over 1 year is always annualized. It means the average return over that time. 5 years, of course, we're still collecting all of the gains of the 12-year bull market, so the 5-year returns much higher than normal on an annualized basis. And over the 10-year return, it still is not hit too hard by about the 14% current return year to date. The graph shows just the first quarter and the path of the stock market, along with all the news that hit the market. And the 24th, of course, shows that when the war started, there was the big dip, then a recovery, a slide down. There was another recovery right towards the end of the quarter. And then this quarter, the second quarter, has started on a down note. This looks a little further for the last 12 months, and it's been a bumpy ride, especially in the beginning of this year. We enjoyed really good returns, unusually large returns in the pandemic year of 2020 after the big decline, and 2021 was another big year for equities. And this is showing where we are right now and all the news that went along with the price. U.S. stocks, we're going to take a look at different types of stocks, and large value was the best performing category. Small growth got hit the worst. Everything was negative, and different types of stocks had different returns. We'll look at international developed, very, very similar graph. Value stocks are low price stocks with low PEs, and that's where investors tend to go when they get out of growth and tech. They'll rotate into value. And so large cap had returns, but growth had the biggest decline on the international. In emerging market stocks, again, value lost the least and growth lost the most. Country returns, I've highlighted the US. It's kind of in the middle with very volatile returns on either end. Peru on one end was up 30% for some reason in the quarter. And Russia, as could be expected with all the sanctions, suffered a huge decline. I think this kind of implies that the data wasn't available after a certain point, because they didn't have a 100% decline, but they did decline by about 40%. Real estate, which I don't always take a look at, I'm highlighting real estate at the moment to compare real estate returns with the real estate loan fund that we use for qualified clients. So this shows the quarterly returns for real estate. This quarter was a down period. Real estate's been doing well over the 1 year period. Over the 3 year annualized, it's got decent returns. The US is good, and all along the US has higher returns and annualized returns than global US, and real estate's been strong during the whole time that the US stock market's been strong. We have a REIT that we use for qualified. You have to be an accredited investor, but many clients own a loan portfolio that's based on real estate, and it just pays 6.5% every year for the last year. So we're looking for safety income as a replacement for some fixed income, and that has worked. We obviously do own lots of real estate in our portfolios because many of the companies in our diversified portfolios own real estate. This is commodities, which is notoriously volatile. It's not uncommon to see 50 and 60% returns on various resources, and it's pretty obvious what's going on. There's supply chain issues, and then a tremendous amount of activity in resources comes out of Russia. And so when supplies are cut off or reduced, the price goes up, and we all know that from what we're paying in the pump. It is always interesting to look at a longer issue for context. I've, of course, been following the stock market and commodities for all the years I've been in the market, and I've seen many periods of high returns, like we have 3 year periods, but this has had an extremely long period of low returns for commodities. So the 10-year annualized returns remains negative despite the quarter returns and the 1 year returns and the 3 year annualized returns being so great. Of course, I can't tell the future, and I'm not sure where that's going to go. But again, we don't overweight commodities, but we own commodities in the funds that in the diversified funds that we own. Fixed income is also another slide that I don't always show because it's usually pretty boring, but of course it wasn't. With the big increase in interest rates, we had a big decline in bond prices. The quarterly results demonstrate something about the duration. So these are short-term bonds. A one-year bond only lost about 1%. What you'll see in general is that the duration times the decline will equal the return. So if you have a one-year bond and a 1% rise in rates, that causes bonds to decline by 1%. And this is the 1 through 5 years, probably has an average of about 3.5 years duration. A rise in rates causes a decline of about 1% times the duration, on down until you get to the long bonds. So the long bonds were hit the hardest. In general, we are in intermediate to short-term bonds. A couple of years ago, when rates went under 2%, I sold all of our long bonds and locked in capital gains. And that's how we usually play it. When rates are really low, we stay out of longer term bonds and we go into shorter term bonds. So we didn't miss everything, but over the longer term, we're outperforming in our bond portfolios. This is the editorial from DFA. I always find it interesting. I think this one is particularly interesting as it talks about the emotions that we all go through when the stock market goes up and down. Even very veteran portfolio managers go through the same thing. We tend to be able to control our emotions to some extent through the many reps that we have. But this is a really interesting, I think that's the maybe 3 pages. And there's a ton of really interesting information in that editorial. So that is it for now. I hope you find this information helpful. If you have any questions or comments, you can get in touch anytime. Thanks a lot. Bye-bye.